Look closely at this chart. Sitting here in June 2026, we just witnessed a brutal 3-week stretch. Gold plummeted nearly 20% from its all-time highs, and silver crashed 35% right alongside it. Retail investors completely panicked. The people who bought near the peak watched their accounts bleed out as the mainstream headlines declared the safe haven trade dead. While everyday traders scrambled to sell, sovereign wealth funds and central banks quietly locked away physical metals at a record pace. Why would the most sophisticated institutions on the planet aggressively load up on assets that appear to be in a freefall? Understanding this behavior requires looking past the surface illusion of this crash to see the mechanical reflex that historically fools retail investors. When a sudden geopolitical shock hits the global system, it triggers a very specific sequence of events. The first economic domino to fall is almost always global oil. Energy serves as the primary transmission mechanism for every modern crisis. Pay attention to this flow. A rising oil price spikes inflation expectations first. The Federal Reserve responds to those expectations by freezing rate cuts. Realizing the Fed is stuck, bond yields go up and the US dollar strengthens. Institutions managing billions start to favor the 5% yield of a US Treasury over the 0 yield of gold. In the short run, they rotate into cash, which mechanically forces metals prices down. This exact algorithmic sequence has played out multiple times throughout history, most notably during the oil-driven panics of the 1970s. The recent plunge in gold and silver represents a predictable short-term market reflex rather than a failure of their structural value. Beyond these short-term mechanics lies the long-term structural reality of the United States economy. Look at these figures. The U.S. government now pays $1 trillion a year purely in interest on its national debt. That sum exceeds the entire defense budget, Medicare, and Medicaid. This runaway debt load, combined with the recent weaponization of the dollar, is fracturing global confidence in the U.S. fiscal system. Sovereign nations are reacting by completely restructuring their reserves. Central banks are moving out of treasuries to buy over 1,000 tons of gold a year, more than double the historical average. They are hoarding physical gold because it is the only Tier 1 asset with no counterparty risk that cannot be frozen or sanctioned by another government. This structural thesis applies even more intensely to silver, given its unique role as both a monetary safe haven and a critical industrial material. Industrial demand is surging. Every single solar panel built, every electric vehicle produced, and every AI data center require silver circuitry to function. Despite that intense demand, silver is suffering its 5th consecutive year of a structural supply deficit. The global economy is consuming silver faster than we can mine it. Because silver lacks a central bank reserve cushion to release supply when inventory gets tight, this deficit creates an explosive and asymmetric upside for the price. We are witnessing a transition in the global monetary order on a scale not seen since Richard Nixon closed the gold window in 1971. Uncertainty is the absolute prerequisite for investing opportunity. True wealth is built by having the discipline to let evidence, not fear, dictate your position.